Most people think a liquidity crisis begins when the chart finally breaks. That is not how it really works. A real liquidity trap begins earlier, quieter, and far more dangerously than that. It begins while prices still look civilized. It begins while headlines still sound manageable. It begins while people are still congratulating themselves for staying invested and calling every warning too early, too dramatic, or too bearish. That is the part I want you to understand, because by the time the crash becomes obvious to the public, the valuable decision window is usually gone. The market does not wait for your emotional clarity. It moves when the plumbing changes, and right now the plumbing is changing in a way I have learned to respect, not because I enjoy fear, because I know what happens when a market that still looks healthy on the surface is being quietly drained underneath. That is when the danger is greatest, not after the scream. Before it, if you want the mother line for this whole story, here it is. A liquidity trap does not begin when the average investor feels panic. It begins when the financial system is still pricing optimism, while the cash that supported that optimism is already being systematically removed. That is the line. That is the thing I want fixed in your mind. Because once you understand that, you stop asking the wrong questions. You stop asking whether the SP is near a high. You stop asking whether the market seems calm. You stop asking whether the last rally invalidated the warnings. Those are spectator questions. The better question is this: what is happening to the supply of liquidity underneath the market? And which assets are only standing because investors have not yet noticed how much of the floor has already been cut away? That is the adult question. That is the one I care about, and it is the reason I am much more interested in the Treasury, financing needs, the Fed, balance sheet, credit spreads, and regional bank stress than I am in the daily mood swing of some popular stock. I have watched 6 major market dislocations in my career. Different sectors, different excuses, different headlines, same underlying law. When liquidity is plentiful, weakness gets covered over. When liquidity is withdrawn, weakness stops hiding. That is the whole movie. And the reason this setup matters so much is that a market can keep climbing for a while even after the real vulnerability has already arrived. That is what makes people underestimate it. The surface stays calm long enough to humiliate the cautious and flatter the exposed. Then the structure gives way. That is how late cycle markets punish the majority. Now, let me show you how I think about the trap itself. I call the first mechanism the hidden drain. The hidden drain is what happens when liquidity is being pulled out of the system in ways that do not immediately show up in the headline index, but absolutely show up in market fragility later. Definition is simple. The Treasury needs massive funding. The Federal Reserve is still shrinking its balance sheet. Together, those two forces absorb cash from the financial system. That is the drain. It is not a metaphor. It is not sentiment. It is arithmetic. If the government must issue vast amounts of debt into the market and the central bank is no longer supplying balance, sheets support the way it did in prior rescue eras, then private capital has to absorb that paper. And every dollar that gets absorbed there is a dollar not available to support something else that matters. It matters much more than the average investor realizes. People still imagine liquidity as some abstract background mist. It is not. Liquidity as a resource. It is finite at any given moment. And when the government is pulling hard on the same pool at the same time the Fed is not replacing what it is draining, the rest of the market eventually feels it. Maybe not first in the index, maybe not first in the headlines, but somewhere, always somewhere. That is why I say the crisis has often already started by the time the public is still celebrating the last rally. The drain starts before the break. The break is only the visible confession. Now let me go deeper. When rates rose and the Treasury was still drawing down its cash balance in an earlier phase, a lot of investors looked at the market's resilience and thought they had disproved the danger. They had done no such thing. They were misreading the temporary source of liquidity that was offsetting the tightening conditions. That is how phase 1 of a liquidity trap tricks people. The market still has enough oxygen to keep moving. People think the machine is healthy. It is not healthy. It is temporarily breathing from a tank that is being emptied. Once that tank is gone, the illusion gets harder to maintain. That is what I want you to see. Now let us move to the second mechanism. I call it the surface lie. This one destroys more investors than almost any chart pattern ever invented. The surface lie is the belief that because the major indices look stable or strong, the financial system beneath them must also be stable or strong. Wrong in every serious break I have studied closely. The surface held together longer than the internals. Small caps rolled earlier, credit worsened earlier. Regional banks signaled trouble earlier. Financing conditions tightened earlier. Liquidity got thinner earlier. But because the headline index stayed respectable, people interpreted all of that as noise. That is exactly how a late-stage trap works. The surface keeps enough dignity to silence the warnings. That is why I distrust reassurance from top-line numbers in a structurally stressed environment. A strong headline index can hide a weak market. A weak market can hide a weakening system. And the weakening system is what matters. I do not care if a small handful of mega-cap names can levitate an index for longer than expected. That is not health. That is concentration plus momentum plus denial. I care about what happens when the next layer of financing stress hits. I care about whether bids are deep or thin. I care about whether second-tier assets can still find buyers without discounts. That would have been unthinkable. 6 months earlier, that is how adults read a late cycle tape. The average investor sees near all-time highs and hears safety. I see near all-time highs. During a liquidity drain and hear delay. That is a much darker and much more useful interpretation, because delays do not cancel arithmetic, they accumulate it. Now let us move to the third mechanism. I call it the Treasury vacuum. This is the point where the trap becomes concrete instead of theoretical. The Treasury vacuum is what happens when the government's financing needs become so large that the act of funding the deficit itself drains the market's usable liquidity. Think about what that means. The government is not just spending too much in some moral or political sense. It is issuing so much debt that it changes the oxygen content of the financial atmosphere. That is the vacuum. And a vacuum does not only hurt speculative assets, it hurts anything dependent on easy financing conditions, cheap rollover, forgiving credit markets, or an investor base willing to reach for risk because there is abundant liquidity everywhere. The moment you understand this, you stop thinking of Treasury issuance as background noise. You start seeing it as a gravitational force, because it is one. A large enough funding need changes the opportunity set for every other asset in the system. Why buy this risky thing at a stretched valuation if risk-free alternatives are paying meaningful yields and the Treasury itself is soaking up capital at massive scale? That question alone changes the whole market. And when that question starts getting asked seriously, valuations that looked reasonable under a liquidity-rich regime suddenly look ridiculous. This is why I say the trap is worse than people think. It is not just a market problem, it is a state finance problem leaking into a market structure problem, and once those two merge, the room for a clean escape narrows. Now let us sharpen this further. The Treasury vacuum is not just about how much debt exists. It is about rollover pressure. It is about how much new paper must be absorbed at prevailing rates. It is about the cost of servicing what was previously cheap and is now being refinanced at much less forgiving terms. Every time old debt matures into a higher rate environment, the interest burden rises. That interest burden does not produce new productive output. It does not build roads or factories or cash flows. It is financial rent on old decisions. And the larger that rent becomes, the more the whole sovereign system begins to resemble a structure serving its own liabilities first. That is dangerous. Now let us move to the fourth mechanism. I call it the credibility split. This one matters because it explains why this cycle is harder than the last few rescue cycles. People remember so fondly, the credibility split is what happens when the central bank still has tools, but the market no longer treats those tools as clean salvation. In 2008, the Fed could cut hard, print aggressively, and still look like the emergency doctor with moral authority. In 2020, it could do something similar because the political and public appetite for shock treatment was still there, and inflation had not yet burned the public the way it would later. But once inflation has already returned, once the public has already experienced the erosion of purchasing power, once the debt load is much larger, and once the bond market is less willing to grant the benefit of the doubt automatically, every future rescue looks different. That is the split. The Fed may still try to save the system. The market may no longer believe that such a rescue can happen without serious side effects. That is an enormous difference, because once the rescue itself carries inflation risk, currency risk, or fiscal credibility risk, the old playbook loses its innocence. The average investor still thinks if things get bad, the Fed will step in. Maybe that is not the real question anymore. The real question is, if the Fed steps in, what new damage does that create, and which markets refuse to cooperate cleanly because they see it? That is the credibility split. You can already see its shadow in the long end of the Treasury curve, in the stubbornness of yields, and in the broader discomfort around the idea that monetary easing can simply fix everything without reopening other fires. This is why I say the trap is already here. Not because the Fed has no tools, because the tools no longer come free. Now let us move to the fifth mechanism. I call it the regional fuse. This is one of the earliest and ugliest places the pressure tends to surface. The regional fuse is what happens when institutions closer to vulnerable loan books and thinner funding structures begin signaling stress before the broader public sees the systemic meaning. Regional banks matter because they sit close to real economic stress, commercial real estate exposures, local funding bases, concentrated loan books, asset, liability mismatch problems that look manageable until the deposit base or the mark-to-market environment changes. That is why I watch them so closely. A broad market can ignore regional bank stress for a while. It cannot ignore it forever. If enough pressure builds there, one failure or one clear signal can change the emotional state of the whole market much faster than the index level would have led you to expect. That is the fuse. The public thinks the break starts when the index drops hard. Often it starts when a weaker but systemically revealing segment admits the pain. First, regional banks can do that. They can telegraph the funding strain, the mark-to-market vulnerability, and the liquidity fragility that bigger and more glamorous corners of the market can hide a little longer. That is why a regional bank event is never just a regional bank event when liquidity is already thin. It is a statement about trust. It is a statement about hidden losses. It is a statement about what happens when the surface can no longer cover the plumbing, and when the fuse lights there, the market can go from calm to suspicious very fast. Now let us move to the sixth mechanism. I call it the credit snare. This is one of the cleanest signals I know. The credit snare is what happens when spreads widen enough to tell you that financing is no longer flowing. Normally, even though the equity market has not fully confessed it yet, credit moves first because credit is less sentimental. It cares less about the dream and more about repayment probability, funding terms, and balance sheet strain. If junk spreads start widening meaningfully relative to investment grade paper, I do not shrug and call it a technicality. I treat it as the market saying the cost of money for weak borrowers is changing, and that change will not stay politely isolated. That matters a lot because weak credits do not fail in a vacuum. They sit inside portfolios, balance sheets, funds, insurance structures, and investor psychology. When they start getting repriced, they change behavior elsewhere. Lenders get more selective, borrowers get more desperate, refinancing windows narrow, the market becomes less forgiving. That is the snare. It tightens before the average investor feels the rope. And once it tightens enough, what looked like an orderly environment suddenly has a series of actors who must act under pressure rather than preference. That is when the market turns ugly. I have always trusted credit before cheerfulness. Credit has fewer illusions. Now let us move to the seventh mechanism. I call it the 5 bucket discipline. This is not a slogan. It is how I think one survives and then profits from a liquidity trap without pretending to be clairvoyant. A serious late cycle portfolio is not built for entertainment. It is built for sequence. First bucket is cash and Treasury bills. Not because I want to marry cash forever, because cash is optionality, and T-bills let me be paid while I wait. That matters immensely when the market's best future opportunities may only appear after forced selling arrives. Second bucket is strategic short exposure. Not reckless ego, driven shorting of every popular name, but focused pressure against the parts of the market most dependent on liquidity, low rates, and forgiving financing conditions. Zombie balance sheets, commercial real estate stress, crowded long-duration growth, areas where the old world still sits inside the valuation. Third bucket is gold and monetary real assets. Not because I am forecasting Armageddon, because if the trap breaks and the Fed is eventually forced to respond, the quality of the measuring stick becomes part of the story, and I want something in the portfolio that does not depend on central bank purity for its existence. Fourth bucket is energy and selected hard input exposures. You can print currency, you cannot print a barrel of oil, a cubic foot of gas, or a pound of industrial necessity into existence by decree. In reflation or renewed inflation, this matters. Fifth bucket is defensive cash flow businesses, companies that sell what people still buy when the economy is ugly: toothpaste, food, drugs, household basics, services with durable necessity. These are not glamorous. Good. Glamour has no protective value in a liquidity trap. That is the discipline, not one perfect trade. A structure designed to survive phase 1, profit in phase 2, and rotate intelligently into opportunity when the trap becomes obvious to everyone else. Now let me sharpen one thing here. The point of cash is not to make you feel safe. The point of cash is to make you dangerous later. That distinction matters. A lot of people here hold cash and picture fear. I picture optionality. I picture the ability to buy quality at crisis prices without begging my broker or my bank or my nerves for permission. That is what cash means to me in an environment like this. Now let us move to the eighth mechanism. I call it the four-phase playbook. This is how I think about the path through a year like 2026. Phase 1 is patience. You watch the internals deteriorate while the public still thinks the market is fine. This is where the greatest emotional pressure is to abandon discipline, because the index is near highs and caution feels foolish. That is exactly when patience matters most. Phase 2 is trigger recognition. This is where multiple signals begin to align, a meaningful rise in the long-end regional bank stress becoming impossible to dismiss. Credit spreads widening enough that financing conditions are clearly worsening. This is where defense hardens. Not because certainty exists, but because the cost of waiting has changed. Phase 3 is the break. This is where the market finally translates structural stress into visible price violence. The public experiences it as shock. Prepared capital experiences it as the moment the setup becomes explicit. The short book works. Cash becomes more valuable. Weak holders become involuntary sellers. And finally, Phase 4 is reversal and redeployment. This is the psychologically hardest phase for most people because it requires buying while the emotional weather is still terrible. But once forced selling has done its work and policy response begins turning from theory into action, quality assets can be had at prices that only exist when everybody else is still exhausted. That is where real money gets made, not in the prediction contest in the sequence. That is why I keep coming back to that word. Sequence. You do not need to know the exact date of the break to prepare for the sequence. You do not need perfect foresight. You need a process. Now let me say something hard. Most investors will lose in a liquidity trap, not because they lacked intelligence, but because they will stay married to the surface until the structural reality humiliates them. They will say the market is fine because the index is fine. They will say the Fed has our back because that line worked before. They will say cash is a waste because the market still looks okay. Then the break comes, and suddenly they want liquidity, optionality, hedges, and discipline at the exact moment those things are most expensive to acquire emotionally. That is how the market punishes complacency, not with a lecture. With timing now, let me make the identity flip explicit. Most people think the job in a market like this is to be brave. Wrong. The job is to be structurally literate. That is the flip. A brave fool gets carried out just as easily as a timid fool. A structurally literate investor knows which signals matter, which pressures are compounding, and which assets belong in a regime where liquidity is being drained before the headline tape fully shows the stress. That investor is less excited. Good excitement is not a protective quality. He is less impressed by surface highs. Good. Surface highs are often the final anesthetic. He is more patient, more prepared, less dependent on reassurance. That is the person I want you to become. Now let me give you the operating system I would use. First, stop worshiping the headline index. Second, track the drain, not just the price Treasury funding, Fed balance, sheet reduction, credit spreads, regional, bank strain, long-end yields. These are the instruments of truth. Third, separate surface health from structural health. Fourth, build optionality before the panic asks for it. Fifth, respect the difference between being early and being wrong. The market can mock caution for months and still reward it violently later. Sixth, never marry a thesis so deeply that you cannot change the position when the evidence changes. That includes bullishness and bearishness both. Seventh, keep the buckets: clean cash for flexibility, shorts for fragility, gold for monetary distrust, energy for hard input inflation, defensives for survival cash flow. Eighth, when the break finally arrives, remember that the real money is often made not in predicting the crash itself, but in rotating correctly after the forced selling begins to exhaust itself. That is the operating system. It is not glamorous. It is honest. And honesty is worth a great deal in a liquidity trap because the trap itself feeds on the refusal to be honest about what the market is really standing on. Now let me put the blade into this as cleanly as I can. The 2026 liquidity trap is not something that starts when everyone panics. It starts when the system is still smiling while the cash underneath is being siphoned away. That is where we are. The trap is not waiting for permission to exist. It already exists. The question is whether you are still reading the market from the top down while the real information is flashing underneath. If you are, you will be late. If you stop doing that now, you still have a chance to act like one of the 5% who understand that in markets. What looks stable and what is stable are often radically different things. That is the whole lesson. Not that you should fear every rally, not that every high is fake. That when the plumbing is deteriorating, price can flatter you right up until the moment it cannot. I would rather you respect that now than be taught later by force, because markets always teach. The only question is whether you pay with attention or with money.